The shipping containers along the port of Los Angeles have stopped moving. Not because of a strike, not because of a holiday, not because of weather. They have stopped moving because the cranes that lift them, the trucks that carry them, and the trains that deliver them inland are waiting for instructions that have not come. 43% of every manufactured good sold in America passes through this port. Tonight, those goods sit motionless under floodlights while the Pacific wind moves through empty parking lots. On the morning of May 12th, President Donald Trump signed Executive Order 14-927. The order froze $340 billion in annual trade flows with China. Not tariffs, not quotas, not renegotiation, a freeze. The language was clear. All pending contracts involving Chinese semiconductor components, rare earth shipments, and consumer electronics were suspended indefinitely pending what the White House called a comprehensive security review. The order gave American companies 72 hours to comply. Within 8 hours, the response came. Not from Beijing's Ministry of Commerce, not from the Chinese embassy in Washington, from the Shanghai Stock Exchange trading floor. 8 words appeared on the Bloomberg terminal at 3:17 p.m. Eastern Time. One name, one abturs. We no longer require American market access. The statement was unsigned. It carried no official seal. It was posted on the exchange's internal bulletin system, and within 11 minutes had been screenshotted, translated, and transmitted to every trading desk in New York, London, and Frankfurt. The dollar figures are specific because they are real. American companies hold $91 billion in active supply contracts with Chinese manufacturers. Another $63 billion sits in pre-ordered inventory scheduled for delivery between June and September. The freeze does not pause those obligations. It simply makes them undeliverable. The companies still owe the money. They simply cannot receive the products. Walmart alone has $2 billion in electronics, textiles, and household goods sitting in Shenzhen warehouses that cannot legally cross the Pacific. What happened next occurred in stages. First, the semiconductor sector. Taiwan Semiconductor Manufacturing Company announced it would no longer prioritize American orders. TSMC controls 54% of the global chip foundry market. Without access to their fabrication plants, Apple, Qualcomm, and Nvidia cannot produce next-generation processors. The announcement arrived in a single-paragraph press release issued at 11:40 p.m. Taipei time. No conference call, no executive statement, just the paragraph. Second, the rare earth supply chain. China produces 63% of the world's refined rare earth elements. These materials are required for electric vehicle batteries, wind turbines, military radar systems, and smartphone screens. On May 13th, China's Ministry of Industry announced that all rare earth export licenses issued to American firms were void pending reciprocal trade restoration. The licenses covered $14 billion in annual exports. The voiding took effect immediately. Third, and most consequentially, the consumer goods sector collapsed. Target, Best Buy, Home Depot, and Costco source between 40 and 68% of their inventory from Chinese suppliers. The 72-hour compliance window meant those companies had 3 days to find alternative suppliers or face empty shelves by mid-June. There are no alternative suppliers at that scale. Vietnam, India, and Mexico combined cannot replace China's manufacturing capacity in 3 days, 3 months, or 3 years. Gene is 52 years old. He has worked as a logistics coordinator for a furniture distributor in North Carolina for 19 years. He drives the same route to work every morning, stops at the same gas station, orders the same coffee. On May 14th, his company told him they were closing the warehouse. Not downsizing, not restructuring, closing. Gene said this during a recorded interview with a local television station. I thought tariffs were about making things fair. This isn't tariffs. This is just everything stopping. I don't even know what we're supposed to do now. Dakin. The cascading consequences moved in concentric circles. Retailers announced hiring freezes within 48 hours. Logistics companies began furloughs. Port workers in Los Angeles, Long Beach, and Seattle received notice that shifts would be reduced by 60% starting June 1st. The National Retail Federation issued a statement estimating that 420,000 jobs in the supply chain sector were at immediate risk. The stock market responded accordingly. The Dow Jones Industrial Average dropped 1,147 points on May 13th. The S&P 500 fell 4%. The Nasdaq, heavily weighted toward technology companies dependent on Chinese semiconductor supply, fell 1%. It was the largest single-day loss since March 2020. Restaurants that depend on imported kitchen equipment faced delays stretching into 2027. Schools that ordered Chromebooks for fall classrooms received cancellation notices. Hospitals that used Chinese-manufactured MRI components were told replacement parts would not arrive. Auto manufacturers that build electric vehicles shut down 3 assembly lines in Michigan, Tennessee, and California because the battery cells they required were frozen mid-shipment. Then the political fracture appeared. Iowa farmers who export soybeans to China saw futures prices collapse by 23% in 4 trading sessions. Wisconsin dairy producers faced the same collapse in whey protein exports. These are not progressive urban districts. These are counties that voted for Donald Trump by margins of 30, 40, and 50 points. By May 15th, 12 Republican members of Congress from agricultural districts had issued statements calling for immediate suspension of the executive order. Warren Buffett, speaking during Berkshire Hathaway's annual shareholder meeting on May 17th, addressed the situation directly. He did not use the word tariff. He did not use the word freeze. He said this, When you tell the world's largest manufacturing economy that you no longer need them, you should not be surprised when they take you at your word. Trade is not a performance. It is a dependency. And dependencies, once severed, do not restore themselves on command. That phrase, dependencies do not restore themselves on command, circulated for 6 hours before the signature phrase arrived. It came not from the White House, not from Congress, not from any official American source. It came from a translated statement issued by China's Commerce Ministry at 9:22 a.m. Beijing time on May 18th. The statement was 94 words long. 73 of those words were procedural language about regulatory frameworks and bilateral consultation mechanisms. The final 8 words were these: We no longer require American market access. Those 8 words appeared on the front page of the Financial Times, the Wall Street Journal, and the South China Morning Post. They were projected onto the side of a building in Hong Kong during a protest. They were translated into 27 languages within 36 hours. They became the headline of every major business publication because they inverted the assumption that had governed American trade policy for 40 years. The assumption was that China needed access to American consumers more than America needed access to Chinese manufacturing. The 8 words stated the opposite, and the market believed them. By May 20th, the freeze had cost American companies $480 billion in market capitalization. The Treasury Department issued a clarification stating that the executive order applied only to certain high-risk sectors, not all trade. The clarification did not matter. The supply chains had already fractured. The contracts had already been voided. The alternative trade relationships had already begun forming. Japan announced a new semiconductor partnership with Taiwan and South Korea that explicitly excluded American firms. The European Union accelerated rare earth mining projects in Greenland and Sweden to reduce dependence on both China and the United States. Trump tried to reframe the freeze as leverage. He tried to describe it as a necessary security measure. He tried to claim that American manufacturing would benefit once domestic production replaced Chinese imports. But domestic production cannot scale in 72 hours. It cannot scale in 72 weeks, and the global market had already moved on. The 8-word response was not a threat. It was a statement of fact. China no longer required American market access because 140 other countries still provided it. America required Chinese manufacturing because no alternative supply chain of that scale existed. The lesson is this: power is not volume. Power is not the ability to freeze $340 billion in trade with an executive order. Power is the ability to absorb that freeze without flinching and watch the other side collapse under the weight of its own miscalculation. Trump had the authority to sign the order. China had the infrastructure to ignore it. Those are not the same thing. And in trade, as in all dependencies, the side that can walk away is the side that was never dependent in the first place. We no longer require American market access. 8 words. 94-word statement. The 6.4% market collapse, 420,000 jobs at risk, and one executive order that proved the most expensive lesson in modern trade history, not because it failed to hurt China, but because it hurt America first, faster, and harder than anyone in the White House had calculated. Please hit the bell icon and subscribe my channel for daily updates.